Okay, good day audience, Assalamu alaikum. Today's class is linked to final account. This is Mustafa Mirchawala, your trainer, and today we'll discuss two latest questions of final accounts. But before moving on to final accounts, let me give you some basic revision of IAS IFRS, some quick recaps of IAS IFRS, which normally comes in final accounts. Okay, now in past, normally there was a examiner routine was they used to give one trial balance, and by using that trial balance you have to make one SOCI, SOCHI and SOFP. SOCI, SOCHI and SOFP, that was traditional format. Still this format is applicable. Sometimes this type of questions may come in exam. Okay, but according to the latest questions, if you see, so normally they ask profit reconciliation. Normally they ask profit reconciliation. That means you are already provided with unadjusted or uncorrected, or in other words, wrong profit is already given in the question, and you need to do some adjustments. You need to do some adjustments. You need to correct that profit. Okay, so first of all, what you have to do in these questions, these type of question, from unadjusted profit to corrected profit, this is the first journey you have to do. Then secondly, sometime examiner asks SOCHI and sometime they ask SOFP, or sometimes in requirement C, examiner asks the calculation of earning per share. I hope you remember IAS 33, IAS 33, earning per share. Okay, now let me start the class. You already know some standards which are very common in final accounts. The most popular standard is financial instrument. Financial instrument is very common in your final accounts topic. And what areas may come? The first of all, the very common wholesale area is amortized cost accounting. Amortized cost accounting in terms of financial liability. Financial liability means you have taken loan, not you have given loan. You have taken loan. Okay, and in this case two interest rates are normally given: coupon rate and effective interest rate. Coupon rate and effective interest rate. Okay, so you need to book interest expense or finance cost, interest expense or finance cost using effective interest rate, okay. But normally in 99% questions, cash interest paid, that is coupon interest paid, is already adjusted, has already been adjusted. So you need to do the remaining adjustment. Normally you need to do the remaining adjustment. Also in some questions, sometimes the examiner ask about the issue cost treatment. Examiner already did wrong treatment of issue cost, and they need you to correct that treatment. Now wait, you hope you remember the treatment of issue cost. Wait, you have taken loan for 5 years. That means this loan is going to benefit you for 5 years. So now whatever cost you are going to incur, for this loan, you need to spread, you need to amortize, you need to spread that cost out over the life of the loan. So in order, so sometimes at the time of issue of loan notes, you incur some issue cost. So just think, why did you incur this issue cost for this loan, for to take this loan? And this loan will benefit you 5 years. Not just 1 year. So obviously this issue cost must be spread over the life of loan. This issue cost must be spread over the life of loan, right? But what examiner normally does, they book issue cost immediately in P&L. Complete issue cost in admin expenses. Now. So that's the wrong treatment. So you need to reverse it. You must spread issue cost over the life of loan. Not on the same day. Okay, I hope you remember, there are some questions like this, like dune in your exam kit. There is a question dune, and one or two more questions in which examiner has done the same mistake, right? Okay, so be careful with this issue cost thing. You need to spread the issue cost over the life of loan. Then one one more area, I will also teach you this area, convertible loan note area. Very routine and very cash marks, very cash marks. Convertible loan note area. Convertible loan note is also called hybrid or compound financial instrument, which contains both debt and equity element, right? So always first check if if convertible loan note is issued in front of you in the same accounting period. If convertible loan note is issued in front of you in the same accounting period, so first of all you need to split. First of all you need to split debt and equity. First of all you need to split debt and equity, debt and equity. And how you gonna do this? First of all, treat the complete transaction as a pure loan and identify all cash flows. There are two types of cash flows basically: physical interest, and finally the redemption amount, the principal amount. Okay, plot those cash flows, and discount them. Plot those cash flows and discount them. Compute the present value using the market rate. Compute the present value of all future cash flows using the market interest rate. Then you will get present value of liability element. Now the difference between consideration, the amount of total loan, and the present value of loan is the equity option. So you need to make some entries at the day one, and also you need to calculate the finance cost. Don't worry about this topic, this will come in our question today, so it's not a big deal. One more easy area of financial instrument is classification of financial asset. I hope you remember IFRS 9. You can invest money in equity market as well as loan market, and as well as loan market. So if you have invested funds in equity market, that means you have bought shares of certain company. So then you have two options, then you have two categories to classify your financial asset. The first one is fair value through PNL. And the second one is fair value through other comprehensive income. Okay, I hope you remember that fair value through PNL is the default category. Category. That means if examiner is silent, that means you always classify the investment in fair value through PNL. In fair value through PNL, the investment is carried at fair value with all changes in fair value to be taken to PNL. Including the transaction cost. But when it is written that accountant has done irrevocable election. Don't forget the word election. To classify the investment at fair value through OCI, then you must go for fair value through OCI. In fair value through OCI, again the investment is classified at fair value. Right? Okay, and but this time all changes in fair value, upward or downward, to be taken to OCI. But don't forget, in this case the transaction cost will be capitalized. Okay, right? And now one more thing. In future when you sell in future when you sell this investment, when you dispose of these shares of fair value through OCI, I must say all previous revaluation reserve will be transferred to retained earning. That means within equity transfer. Okay, so these are very famous areas in which normally comes in final accounts, and you must know, right? Then with IS 16 the PPE, property plant and equipment, you must remember the revaluation issue. I hope you remember there are two measurement models. The first one is cost model and the second one is revaluation model. Okay, so definitely there is an option, you pick one model when you buy the asset. But in the examination, you will be ready made given which model is being used. Okay, so don't worry about it. Now With the revaluation, model, always first try to point out, the date of revaluation, in the question. And there are few cases related to this. Sometimes examiner revalues the asset at the beginning of the year. Sometimes examiner revalue the asset at the beginning of the year. So in that case, you first revalue the asset. You first revalue the asset at the beginning of the year, and then you calculate this year depreciation. According to the updated market value. Second case, sometimes examiner revalues the asset at the mid of the year, at the mid of the year. So what you do, first half year calculation is calculated using the old style. First half year depreciation is calculated using the old style. Then at the mid of the year you do revaluation, and the remaining half year and the remaining last half year depreciation is calculated using the updated style, using the updated market value style. Okay, right? And the third and the easiest, the most easy peasy case, revaluation is done at the end of the year. Revaluation is done at the end of the year. How we do it? Now that means the whole year has been passed. So simply calculate the depreciation for the year using old style, using complete depreciation using old style, and then do revaluation at the year end. Then perform revaluation at the year end. Now there is a question, sir, is this necessary? Is this mandatory? To make entries? Is this mandatory to make entries of revaluation in the question? No, even examiner don't make it. So it's your choice. If you want to make it, your wish. It's not mandatory, right? Now then, do remember the issue of self-constructed asset. Sometime you construct asset for yourself, sometime we construct asset for ourselves, for our future property, plant and equipment use. Okay, so in that case, you will capitalize all normal cost. You will capitalize all material, labor, overhead, all normal cost you will capitalize during the production. But don't forget, if there is any abnormal cost, you are not supposed to capitalize it. That abnormal cost will be charged in P&L, or in many cases cost of sales. That this will be charged in cost of sales. Okay, right? I think this is very famous type of adjustment. I forgot the name. It's from Keystone. Yes, I think there is a past paper question, Keystone. So normally when you are doing construction, and when you are incurring labor, material or overheads for the construction of that building or warehouse, so that cost you need to capitalize. That means that cost you need to record as an asset. But sometimes examiner do it intentionally to check you. They book all these costs in cost of sales. Means like they expense it out immediately. So that's an error. You need to correct it. You need to recapitalize it. I'm sure there is a question, Keystone. In that question they have done this. One more very old question, Harrington. One more very old question, Harrington. In that question they have also done the same error in adjustment number 2. Okay, so be careful with this thing, that only abnormal cost you can book in P&L. All normal cost should be capitalized if you are constructing asset for your own. Okay, then one more issue sometimes it also comes, and you must all F7 student must know this issue. This is compulsory disposal cost. See, look at the screen. This is compulsory disposal cost. I hope you remember, or sometimes we call it decommissioning liability. This topic is not only connected to IS 16 but also IS 37. This topic is not only connected with IS 16 but also IS 37 provisions, contingent liabilities and contingent assets. Okay, now listen. What happens sometimes, you in the question it is written that you have just acquired a mining rights, you have just acquired mining rights for next 10 years or 20 years, right? And there is a condition of government that whoever will destroy this mine, whoever will use this mine, whoever will consume this mine will incur a compulsory disposal cost at the end of the life, of mining. That means after 10 years, you need to restore, you need to landscape, or you need to restore this site, and you have just signed it. So there is a present obligation for this, there is a present obligation, there is an obligating event for this. So definitely you need to book provision. So what you do on the day one, you make the entry PPE debit and provision credit. On the day one, you make an entry PP debit, PPE and credit provision, right? And obviously, just think over it. Obviously, you are liable to do this after 10 years. You are liable to do this after 10 years. So that means this is an obligation which you need to pay after 10 years. So all obligations that are payable 1 year or after, you need to discount. All obligations that are payable 1 year or after, you need to discount. So hope you remember, boys and girls of F7, hope you remember that you need to do discounting. You need to do discounting. You need to do discounting for this amount. And then once you have done discounting, from the discounted value, you have to make this entry. And then you have to do unwinding of discount as well. Obviously, the interest rate which is used for discounting, the same rate you have to use for unwinding of discount. Okay. So in this type of question, you have to calculate interest expense, that is unwinding of discount. You have to calculate the depreciation of this thing. See, you need to calculate depreciation of this PPE. Okay. So don't forget to do all these things, and you must know all these things. And this is not difficult. Once you practice 2-3 questions, it will be very easy for you, right? Then if you come to IAS 37, in IAS 37, sometimes in one question, unwinding of discount, the entry of unwinding of discount is interest expense debit and provision credit or liability credit. Debit interest expense, credit provision or liability. Okay. So interest expense things goes to income statement, finance cost. Okay. And the liability is added up in the liability is added up in the opening balance of provision. Okay. Now in IS 37, I have seen in the recent past papers that they ask these areas. Sometimes we cannot book provision. In some cases, in some areas, we cannot book provision because IS 37 is very strict regarding the booking of provision. Look at here. If there is no present obligation, or if there is no obligating event, you cannot book provision at all. You can't think of booking provision at all. It's not allowed. Okay. So hope you remember these cases. Self-insurance. You cannot book provision for self-insurance. There is a question in your final accounts, MOBI, MOBY, MOBI. In MOBI question, examiner has booked self-insurance provision, which is not allowed. There is no present obligation because no accident or no bomb blast has been done. So there is no obligation of self-insurance. So you cannot book provision for self-insurance. So if you need to practice this thing, MOBY, MOBY adjustment number 2 or 3 is excellent for this. Okay. So no more provision for self-insurance. Then no more provision for part replacement. For example, you bought a big machinery today, or you bought a ship today, and there is a spare part, in that ship or in their aircraft which you need to replace after every 3 years, now the 3 years. Now the question is, can we book provision for that? Can we book provision for that part replacement thingy? No, 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 not at all. Why? Because we don't have any present obligation. Why? What's the logic? There is a possibility you sell the whole asset after 1 year. You sell the complete asset after 1 year. So if you sell this complete asset after 1 year, you don't need to change the spare part after 3 years. So that's not a present obligation. Okay. So now after the introduction of IS 37 in the world, you cannot or we cannot book provision for part replacement. So sir, what you have to do? The part replacement thing is should be treated like complex asset. I hope you remember the complex asset area in IS 16. Complex asset is an asset which has different components with different useful life. So component each component will be depreciated separately on its own life. Each component will be depreciated separately on its own life, right? Like airplane, like ships and all, right? Now future operating losses. Yes, I hope you remember, and this has already been tested. You cannot book provision for future operating losses. You cannot book provision for future operating losses. You cannot book provision for future operating losses. Why? Just think. I'm saying that next year I will have big losses in my business. So I'm booking a provision for that. No, it's not allowed. Why? Maybe before next year I just simply close my business. So that means that event will not occur, right? So there is no present obligation of future operating losses. So you must know all these areas. These are very famous areas which examiner routine ask. Now, one positive thing or one good news for you students in for F7 final accounts, especially if you see last 10 years, 15 years past papers, you will see many transactions they are repeating after 3 years, 4 years, right? Many transactions like financial instrument is very routine. Convertible loan note after every 2 or 3 years, same, or even after 2 attempts, they test this thing. Okay, so don't worry about final account, it's very routine area. There is a question here. Sir, kindly explain the difference between complex asset and overhauling asset. Wait, giving you short answer. For your exam, for from the point of view of treatment, both treatment is almost same. Okay, in terms of calculation, treatment is same, right? Because overhauling is also depreciated separately, and in complex asset you also depreciate each and every component separately. So in terms of calculation, the topic is same. Yes. Now you all know that the conditions of booking provision is 3 conditions: present obligation, probable outflow. Probable means 50% plus chances. Probable means 50% plus chances. Probable means 50% plus chances, right? Okay, so in that case, listen, it happens in one question, I think. Candle, yes, candle. There were only 20% chance in the question. It was written there are only 20% chance of outflow, and still the examiner booked the provision. So it's wrong. You cannot book. The criteria is 50% plus chances, means probable chances. The criteria is 50% plus chances, means probable chances, right? So you cannot book provision in such case, right? You need to reverse it if examiner has booked. One more thing, for unavoidable legal costs we need to make provision irrespective of the outcome. Yes, in some in court cases in court cases, sometimes lawyer says you, sir, there is a just 20% chance that you will lose the case. Lawyer says you, sir, there is a 20% chance, there is a 20% chance that we'll lose the case. There is a just 20%. That means no provision. But one more thing, lawyer told you, sir, whatever will be the outcome, positive or negative, you have to pay my fees. Sir, you have to pay my fees. Whatever will be the outcome, you have to pay my fees, plus you have to pay the legal fees of stamp duties and all. So this is what we call irrecoverable or unavoidable legal cost, and this must be booked. This must be booked irrespective of the outcome. This must be booked irrespective of the outcome. Okay, now the question is, sir, is there any past paper for this? Yes. The name of that past paper is candle. The name of this past paper is, I think, candle. Okay, so you can see these two transactions in there. No. There is a question. If the chances are 50% plus, then you book provision, and if the chances are less than 50%, and more than 10%, like possible, then we make contingent liability disclosure. Okay, thank you. Now, one very famous adjustment of final account, very famous and very routine adjustment. Normally, I have seen in my whole career, many students, they just memorize it. They just, because this is almost same in every question. And that is related to IS 12 income tax, What examiner asks you, in income statement after PBT, you have to book tax expense. In income statement after PBT, you have to book tax expense. This tax expense is basically the combination of current tax and deferred tax. Whatever tax expense you report in the income statement is basically the combination of current tax and deferred tax. That is total tax. Okay, and hope you remember, in current tax you normally do two workings. The first thing is under over provision. From last year, because last year tax we pay this year. Last year's tax we pay this year. So the first thing is under over provision. Under provision is your expense and over provision is your income. And definitely wait, there is a recognition. When under provision is expense, so it must be on the debit side of the trial balance, and over provision is income, so it must be on the credit side. Of the trial balance. Okay, right? The second thing is current tax liability. This year's estimated tax liability is also your expense. So you just netted off these two and you will get your current tax. The second thing which you need to calculate is deferred tax. Deferred tax expense or income. Deferred tax expense means charge, or deferred tax income means credits. Okay, how you do it? How you do this thing? You make one account. See this T account. You make one T account of deferred tax. Open your eyes. You make one T account of deferred tax, and in that T account, this opening liability is ready made, always given. Opening deferred tax liability is ready made, always given at the top, right, or at the trial balance. Then you have to calculate this closing liability. Or sometimes sometimes examiner gives you ready made. Closing deferred tax liability. But what if you are asked to calculate this closing? So how you do it? Taxable TD at the year end, multiply by the tax rate. For example, the tax rate is 30%. In this way you can calculate. Okay, year-end taxable TDs multiplied by tax rate, year-end taxable TDs multiplied by tax rate, you get this closing. Okay, now normally the difference, if the difference is coming on this side, this is your expense, this is your expense, and if the difference is here, this is your income or credits, this is your income or credits. Okay, in simple terms, if the balancing figure, if the balancing figure is here, if the balancing figure is here, then this is your expense or charge, and if the balancing figure is here, that's your credits. One more thing, or we say it's a routine topic. One more thing, what it's also a routine topic, and that topic is deferred tax on revaluation. Deferred tax on revaluation. Sometimes there is upward revaluation of IS 16 in the question, upward revaluation of IS 16 in the question, and there is a deferred tax relating to that upward revaluation. So what entry you make for that? Hope you remember what entry you make for that. The entry for deferred tax on revaluation is, this is the entry C. Revaluation reserve debit and deferred tax liability DTL credit, revaluation reserve credit, and deferred tax liability credit. See, the entry for deferred tax on revaluation is revaluation reserve debit and deferred tax liability credit. So see, this you need to post. You need to post this entry. You need to post. You need to post this entry. You need to post this entry, right? Okay, and then you need to calculate the balancing number of PNL. Then you need to calculate the balancing number of PNL. Then you need to calculate the balancing number of PNL. Okay. Okay. Now, for the working point of view, you have to make this packet. This is the total tax packet. This is the total tax packet. This is the total tax working. What, how many things? Maximum three things come in this total tax working. The first thing is estimated current tax liability. Estimated current tax liability. Okay, ready-made given in the adjustment. Number two, from the trial balance, you have to pick one of the two things. Either you will be given under provision. If under provision is given, that's your expense. If over provision is given, then that's your income. See, you will deduct it. You will deduct over provision. If over provision is given, you need to subtract it. Okay, add under provision and less over provision. Now this thing is your current tax. Okay, now for deferred tax, if you get a deferred tax charge, if you get a deferred tax charge, see here, if you get a deferred tax charge, you need to add it, and if you get deferred tax credits, you need to subtract it. Finally you will get your total tax expense. Finally you will get your total tax expense. Now look at the screen carefully. Which thing will go where? Which thing will go where? So first of all, this current tax liability, this year current tax we pay very next year. This year current tax we pay very next year. So this is your current liability at the year end. This is your, my dear student, this is your current liability at the year end. Okay, this total tax expense will go in income statement, that is SOCI. Okay, and finally wait, and this closing deferred tax liability is a non-current liability of year end. It's a non-current liability of year end. Three famous things you can see on the screen. Current tax liability will go as a current liability. Number one, the total of this packet, that is total tax expense, will go in the income statement after PBT. And the third thing is the closing balance of deferred tax liability. The closing balance of deferred tax liability will be reported as a non-current liability in the SOFP. As a non-current liability in the SOFP. You can have a look. Now, one more standard which is very famous and very and tested on routine basis is IFRS 15, revenue from customer contracts. Okay. Now, sometimes examiner may test this area stage 3, and that is related to significant financing component, significant financing component. Now, what is this? You might have seen many MCQs, OT cases, even final accounts as well. What is this? You sold the goods. This date is C. This date is 1st January 018. 1st January 18. You deliver the goods now. You deliver the goods to your customer now, and you told them to pay after 1 year. Or you just think, I just taught one student now. I provided the services now, and I told my student to pay me after 1 year. So there is a significant gap between the date delivery of goods, and the actual cash payment. So we need to discount. How? See, for example, after 1 year you have to pay 110. After 1 year you have to receive 110. You have to receive 110, 110 from your customer. Okay, so what you will do, you will first calculate the present value. I hope you remember the discounting. Let us say I is equal to 10%, interest rate is equal to 10%, and there is only 1 year gap. Interest rate is equal to 10% and there is only 1 year gap. So if you calculate the present value of 110 using the discount rate of 10%, it will come as 100. So the first entry which you make, just think, it's like credit sales. It's like, boys and girls, it's like credit sales. Okay, so the entry of credit sales is debit receivable 100 and credit sales 100. Debit receivables 100 and credit sales 100. Okay, debit receivable 100 and credit sales 100. Now open your eyes and open your brain. Please use your brain. Whenever you do discounting, you need to do unwinding. Whenever you need to, the interest rate you use to do discounting, the same interest rate is we used to do unwinding. Okay, so 100 times 10%, 100 times 10% is 10. So there will be interest, open your eyes, there will be interest income of 10, and you will increase the receivable. By 10. Now the students may ask, sir, we have studied that unwinding of discount is basically interest expense. Unwinding of discount is basically interest expense. And now what you are doing, sir, you are writing here interest income. Now wait, look at me. If you unwind the liability, you get interest expense. But if you unwind the asset, this time you are doing unwinding on receivable, you will get interest income. Don't forget, if you unwind the liability, you will get interest expense, but when you unwind the receivable, you get interest income. Okay, so now just think, 100 plus 10, the exact 110 at the end of the year, and at the end of the year you will be receiving 110. Okay, now open your eyes and look at it. Look at the case. Come on, don't waste your time. One more issue. This is related to stage 4. Now wait. For example, I sell three things. I sell machine, I do installation with machine, I provide installation service, and then I give 2 years service, 2 years maintenance service as well. I repeat, I give three things to my customer. Number one, I provide machine right away. I do installation for my customer, and I do maintenance service. I give maintenance service for next 2 years, after sales service, you can say. So if the standalone prices are 50, 80, and 20. If somebody pays separately for these three, the prices are there. But if somebody pays, yes, Azan, wait 2 minutes for Azan. Okay, please. So the standalone prices of machine is 50, installation is 80, and service, 2 year service is 20. Okay, if somebody pays separately for these three, which are this. But if somebody pays in one go for all these three, the package is 120. The package is 120. So hope you remember. Now we need to apportion this 120 between all these three. We need to apportion all these three, sorry, we need to apportion 120 between all these three, among all these three, right? Okay, right. What will be the base? The base for apportion will be standalone prices. The base for apportionment will be standalone prices of these goods. How? Wait, it's very basic maths. 50 plus 80 and 20, see, add it. 50 plus 80 and 20 is 150. Okay, so now let's make the fraction for the first. For the machine, 50 upon 150 into 100. 50, come on, use your calculator. 50 divided by 150 into 100, it makes 33.3% for this. Okay, then 80, see 80 divided by 150 into 100, do it. 80 divided by 150 times 100, 53.3% for this, and then 20 divided by 150 into 100 is 13.3%. Okay, so now what you will do, you will apportion. If you want to calculate the revenue of machine, the revenue for machine is 120 times 33.33%. I think it's 40. The revenue for installation is 120 times 53.33%. Let me check. 120 times 63.96 or 64, and for 2 years service, it's 120 times 13.33%. 120 times, it's, I think 64 plus 40 is 104. Yes, it's 16, right? So that's how you apportion the revenue. Now, one thing, quick thing regarding stage 5. One quick thing regarding stage 5. Now, as the machine is provided on the spot, machine is delivered, the control of the machine is transferred to the customer on the spot. So we'll book revenue immediately, immediate, right? For machine, we'll book revenue immediately, right? Point in time. Then for installation is also done on the same day. Normally installation is also done on the same day, so immediate, again immediate. Installation revenue is also immediate, but use this, but look at here, but for 2 years service you will provide overtime, so definitely the revenue of this 2 year service must be spread over 2 years, must be booked over 2 years. Okay, so these are basic things. No need to fear anything about it. Okay, these are very basic things. Just simply note it down, just simply make notes. You can do it. Okay, have a look. Now the last thing regarding this quick revision is construction accounting. For construction accounting, there is one key thing. For construction accounting, there is one key step. The first key step, sometime even I say this is the king step. Always check that the contract is in profit or loss. Always check the contract is in profit or loss. The contract is in profit or loss. And for this step, you need to use total numbers. Total revenue less total estimated cost. Repeat. For construction accounting, the first step is always check the contract is in profit or loss. And for this purpose, use total figures, means total revenue less total estimated cost. Now wait, how do we calculate total estimated cost? There is a formula for this as well. Total estimated cost equals cost incurred to date plus cost to complete. Don't forget the formula for total estimated cost is cost incurred to date plus cost to complete. Sometimes examiner gives you ready made. Sometimes examiner gives you ready-made total estimated cost, then you don't need to worry about it. Sometimes examiner gives you ready-made total estimated cost, then you don't need to worry about it. And sometimes the breakup is given. Even today I'll teach you one question. In that question the breakup is given: cost incurred to date plus cost to complete. Okay, so use this total estimated cost here. And if the number is profit, if the final answer is profit, positive profit, if profit is given, then book that profit according to stage of completion. Then book that profit according to stage of completion over time. Okay, and there are two methods of calculating SOC. The first is input method. In input method, the formula is cost incurred to date divided by total estimated cost time 100. Cost incurred to date divided by total estimated cost time 100. And the second formula is output method. The second is output. Okay, value of work certified to date divided by total contract price times 100. Okay, so you may have to use one of these formula. Okay, and once you get stage of completion, for example the stage of completion is 40% or 30%, then you will multiply. Look at here, you will multiply these revenue by 30 and this total estimated cost by 30. So you will get the P&L for the year. You will get the P&L for the year. Even I will teach you how to do it in this at today's lecture. We'll be doing a practical question regarding this as well. Okay, so this is the income statement thing. This is related to the income statement thing. Now you may ask, sir, you just told always this is the king step, always check the contract is in profit or loss. So I have just discussed you the case of profit. If profit is expected, then book it according to state of completion. What if there is a loss? What if there is a loss? If loss is expected, then book full loss immediately. If loss is expected, then book full loss immediately. Prudence. Okay, right? Now there is one more working related to SOFP. This is easy working. See, I have just enlarged it, and this thing will go in SOFP. This thing will go in SOFP. But don't forget, first thing. See, I'm using my highlighter again. SOFP is always as at. SOFP is always as at. Don't forget, SOFP is always as at. So you need to use the as at numbers, or you call it to date numbers. So first thing, what you will write, cost incurred. You means past tense. Cost incurred means actual cost incurred. Cost incurred means actual cost incurred. First thing, cost incurred to date, add profit recognized to date. What if there is a loss? Obviously you need to subtract, but I'm right now in my format it's profit. Okay, so cost incurred to date. See, to date, I've changed the color. Even I've changed the color of the pen. And profit recognized to date as at less progress billings. Progress billings means that amount invoiced. So to date, how much invoices you have sent. Okay, then if the answer is positive, then this is your contract asset. If the answer is negative, it's a contract liability. Definitely this contract asset will go in current asset side of SOFP, and this liability will go in the current liability section. Please have a look. Okay, dear students, now we'll start the question, the first latest past paper. But before we start this question, we'll take a 6 to 7 minute short break, and then we'll continue. Okay, okay, so stay tuned. Thank you. Okay, welcome back. Uh, I've already sent you the question on WhatsApp, or you can also take it from the ACCA website, or you can see on the screen as well. Okay, so that's not an issue. Even you can take the pic from here. Now, the name of the question is Dugan Company. Dugan Company is the name of the question. Okay, so they have provided you a trial balance in this question. They have provided you a trial balance in the question. This is latest question. I think it 2 years or 1.5 year old, right? It's a latest question. Yes, recording is started. No issue. Now, so you are given the convertible loan notes, cost of sales, finance cost, operating expenses, revenue, and all. Now, first of all, let's read the requirement. What's the requirement? The requirement says prepare a statement of profit and loss. Simple question, simple income statement. Simple income statement you need to calculate. You need to make a simple income statement. Then in the second requirement, you need to make SOCHI, statement of changes in equity, SOCHI. Okay. And in the third requirement is basic EPS, earning per share, free marks. EPS is total free marks. EPS is total free marks. Okay. Now let's start the question. Now let's start with adjustment number one. Let's start with adjustment number one. Be attentive. First of all, yes, the first technique is always see the accounting period. Always see the accounting period at first instance the accounting period is 30th June x8, so that means it's starting on 1st of July. See, this is your accounting period, 1st July x7 to 30th June x8. This is your accounting period, 1st July x7 to 30th June x8. 1st July x7 to 30th June x8. This is your accounting period. Right now, note number one is basically IFRS 15. IFRS 15, which we had just studied, the construction thing. Dugan Company entered into a contract where the performance obligation is satisfied over time. It's like construction accounting. It's like construction accounting. In construction accounting also we satisfy the performance obligation over time. Now the total price on the contract is 9 million, with the total expected cost is 5 million. Now hold, just have a look and think. Just have a look and think. The total revenue is 9 million and total estimated cost is 5 million. So obviously there is a profit. Obviously there is a profit in the question. Obviously you can see a profit in the question. And when it is the case of profit, listen, when it is the case of profit, you book profit according to stage of completion. You book profit according to stage of completion. Okay. Now one very interesting thing I want to say, and you should think over it. You should also think over it. Whenever you calculate SOC, or whenever it is given ready made, whenever you calculate SOC, or whenever it is given ready made, it is always as at. Stage of completion is always as at. Okay. Now read it. Progress towards the completion was measured at 50% at 30th June x7 and 80% on 30th June x8. Now this is very interesting point, and this is one excellent learning for you. This project has not started in this current accounting period. This is old project. Just think, our accounting period is 1st July x7. Our accounting period is 1st July x7 to 30th June x8. And you can read that this project is old. This project is old. Already 50% complete as at 30th June x7. That means this project has been started last year. This project was started last year. Old project. So whenever you get such questions, you need to make P&L using differential of 2 as at P&L. Again I repeat, relax and listen. If you get such questions in which the contract started in last accounting period, in which the contract started in last accounting period, In that case, if you need to calculate for the year profits, for the year P&L, for the year P&L, you need to take the difference between two as at P&L. You need to take the difference between two as at P&L. Okay. Now, the correct entries were made in the year ended 30th June X7. Thank God. Last year workings are done and they are already correct. But no entries have been made for the year ended 30th June X8. They have not done anything for this current year. They have not done anything for the current year. Now, just hold 30 seconds and look at this and make a plan in your mind, and then I'll show you how to do it. It's not difficult. It's not difficult. Now, listen, look at here. I've made easy sketches for you so that you can feel that question in your mind as well. See, this is our accounting period, this is your accounting period, and this is last accounting period. This is last accounting period. Till the last year, till the last year, the SOC was 50%. SOC was 50%. So whoever was the accountant at last year must have made this P&L last year. See, 9 millions time 9 million was the revenue. 9 million the 9,000. Okay. Now I've just used that complete 9. Okay. But in the exam you have to use 9,000. 9 million times 50% is 4.5, and 5 is the total estimated cost. 5 was the total estimated cost times 50% is 2.5. So this PNL has already been made last year, and this 4.5 and 2.5 has already been booked. This 4.5 and 2.5 has already been booked last year, as at last year. Now let's come to this year. By the end of this year, 30th June X8, the SOC is 80%. By the end of this year, the SOC is 80%. Now let's make as at PNL. As at PNL. So this is the as at PNL. 9 millions times 80%, 7.2. And 5 million is the total estimated cost times 80% is 4. So definitely the difference is, I think, 3.2. Okay. Now, if you want to make, wait. If you want to make a for the year PNLC in between, let me make, if you want to make a for the year PNL, look at here. Then simply take the difference between these two PNL. Simply take the difference between these two PNL. See the revenue 7.2 minus 4.5. Revenue 7.2 minus 4.5. 7.2 minus 4.5 is how much? Wait. It's 2.7, or you call it 2700. It's 2.7, or you call it 2700. And what will come in cost of sales? Wait. The as at cost of sales is 4. As at 30, the total cost of sales as at is 4, and the last year we have already booked 2.5. So 4 minus 2.5 is 1.5, which is 1500. So tell me, this is the for the year profit. This is for the year profit, and let me use the highlighter. Wait, this year PNL we have to make. This year PNL we have to make. Okay. So in the income statement, we'll adjust in sales revenue, we'll adjust 2700. In the income statement, in the income statement, we adjust sales revenue of 2700, and we adjust cost of sales of 1500. In the income statement, we'll increase the existing sales revenue by 2700 and the existing cost of sales by 1500. Okay, so automatically this profit will be adjusted. Now there is one question, sir, why don't you work for SOFP now? Why don't you work for SOFP? Hope you remember the contract asset or contract liability thing. Hope you remember the contract asset or contract liability thing. No need to do it. No need to do it, because go and check the question requirement. I have already sent you the question. Go and check the question requirement. I have already sent you. I have already sent you. Listen, listen. In the question, it is clearly written no SOFP is required. No SOFP is required. So no need to do work for SOFP. And also the data is also not given. SOFP related data is also not given. So you cannot calculate it as well. Okay. So simply you have to adjust these numbers. You have to adjust these numbers in the income statement. You have to adjust these numbers in the income statement. And now with the practical thing, just write, you should also write a little bit theory. As the contract started last year, that is before 30th June X7, that's why we need to take difference between two as at PNL, between two as at PNL. Okay, so you should guide this as well. There is one question from a student. Sir, if we simply take the difference between 80 and 50, look at here. If we simply take the difference between 80 and 50, the 30%, the answer will be same. Yes, I know. In this question, the answer is same. But if you have seen the other past papers and the exam kit question and the study text question, normally this total estimated cost, the total estimate, just think the word total estimated cost, it changes. It changes. So if you try to apply the shortcut every time, it won't work. Okay, so be careful. So it's better you make the two PNL, make the habit of two PNLs. Okay, the simple short, this shortcut may work here. Okay, I agree, but it won't work in each and every question. So be very careful. If you understood the question, if you understood this part, come on, hit me a message, on the chat box. Come on, quick. Okay. Okay, dear students, now the second requirement is related to IS 37, and there is some unwinding of discount as well. Don't forget, the accounting period must be in your mind. The accounting period must be in your mind, and your accounting period is 1st July X7 to 30th June X8. 1st July X7 to 30th June X8. Don't forget. Now, on, see the date, on 1st of January X8, that means mid of the year. 1st January X8 means mid of the year. Dugan company was notified that an XXX means existing ex-employee had started court proceeding against them for unfair dismissal. Legal advice was that there was an 80% chance. Yes, it is probable. 80% chance is probable. Okay, so there is a present obligation plus probable outflow. See, you can clearly see the conditions. You can clearly see the conditions of provision. Okay, so definitely you need to book provision. That Dugan company would lose the case and would need to pay an estimated 1.012. 1.012 means if we adjust 30, it become 1012. If you adjust 30, it become 1012 on 1st January X9. Now wait. Right now we are at 1st January X8. Right now we are at 1st January X8. And we need to pay this amount on 1st of January X9. We need to pay this amount on 1st of January X9. That means exact 1 year gap. And you know this is the basics of F7, that all liabilities and all payables which we have to pay 1 year or after, we need to discount. So definitely discounting is must here. Okay, now Based on this advice, Dugan Company recorded a provision of 800k. 800k. Oh, let me check. We need to check the present value. If this is 800k, then it's okay. Otherwise, we need to do adjustment. Only 800,000. 800,000. And has made no further adjustment. The provision was recorded in operating expenses. Okay, no issue. Dugan Company has a cost of capital of 10% per annum, and the discount factor. See, they have just for the savings of time, they have given you ready-made, and the discount factor at 10% is 0.9091. This is relevant. Okay, I hope you can make a plan in your mind. How you will make a plan? You will be doing discounting. Of 1 year, and the ready-made discount factor is given. How to do discounting? If discount factor is given, simply multiply the future cash flow with the discount factor. Simply multiply the future cash flow with the discount factor. You will get the present value. Okay. Now let's do it. Okay. Come on. I've just written one or two lines. According to IS 37, provision is needed, but as the payment is after 1 year, that's why we need to discount the amount. Now, the amount was, my dear student, the amount was 1012. 1.012 means 1012. Okay, and we are right now we are at 1st January x8, and this amount is payable at 1st of January x9. So exactly that there is a gap of 1 year. Okay, so let's do the discounting. 1012 is the future cash flow times the discount factor 0.90, wait, times it's almost 920. Okay, so we should have made the provision. Of 920k. But we just read the question, and I've already sent you the question. Keep the question in front of you on another screen. Examiner has only made the provision of 800. Okay, they have made the provision of 800, but the real amount, the amount which should be used, is 920. So definitely we need to make an extra provision of 120, as only 800k okay. So the entry will be P&L debit, or wait, they have already guided us that this should be booked in operating expenses. You can also write the debit P&L, or you can write operating okay. Operating expenses debit and provision credit. Operating expense debit and provision credit. Okay, so this is the first entry. Which we need to adjust. This is the first entry which we need to make. One more thing which is left. The accountant has only made the provision, but can you just think, we have just done the discounting. Thing, and whenever we do discounting, we need to do unwinding as well. Whenever we do discounting, we have to do unwinding as well. But be careful. Unwinding, listen my words. Unwinding you have to do just by according to your accounting period. Unwinding you have to do according to your accounting period. Now look at your accounting period. See, your accounting period is your accounting period is 30th June X8. Your accounting period is 30th June X8. Your accounting period is 30th June X8. Your accounting period is 30th of June X8. Your accounting period is 30th June X8. Okay, so only 6 months, 6 months unwinding of discount. Now wait, this 920 is the present value. Okay, and you remember these famous dialogues. You must have remembered these famous dialogue. Whatever rate is used for discounting, whatever rate is used for discounting, the same rate is used for unwinding as well. Whatever rate we use for discounting, the same rate we use for unwinding. But don't forget, it's only 6 months. Oh, so what will be the unwinding amount? See, interest expense is equal to, wait, 920 times 10% times 6 upon 12. Come on, 920 times 10% times 6 upon 12. I think it's 46. Okay, so the entry will be debit interest expense, 46, and credit provision. Entry is not needed, but I'm just making it 46. So the adjustment is done. Finally, the adjustment is done. Finally, the adjustment is done. Look at here. The adjustment is done. So, sir, how many things we need to adjust? Sir, how many things we need to adjust? Only two things. Only two things. Open your eyes. The first thing is operating expenses of 120. The first thing is operating, you need to increase the operating expenses by 120. And the second thing, you need to adjust interest expense by 46. You need to adjust interest expense by 46. You need to adjust interest expense by 46. You need to increase interest expense, finance cost by 40. Just two things. Just two things. Okay. Okay, just giving you 30 seconds. Have a look, have a look, have a look, and tell me if you understood it. Tell me, type it, please. Now, let's post these two adjustment in the income statement. First of all, let's post these two. In the first adjustment, the 2700 is revenue and 1500 is cost of sales. 2700 will be posted in sales revenue and 1500 in cost of sales. Okay, let's post it. First of all, see, see the income statement. Can you see the income statement? The numbers I have already written are from the trial balance. The number already written in the income statement in front of you are taken from the trial balance. You can see, you can check, you can verify from trial balance. Okay, you have the question. So 43,200 is the existing number, and we'll add 2,700 in the sales revenue. We'll add 1,500 in cost of sales. Okay, then we'll add 120 in operating expenses. Adjustment number two, 120, we need to increase the operating expenses, and 46 in the finance cost. See, I have posted I have posted these three things. I have posted these three things in front of you. You can see the sales revenue. I have adjusted the sales revenue figure number one. I have adjusted the cost of sales number. I have increased the operating expenses of adjustment number two, and the finance cost by 46. Okay, the existing numbers I have taken from the trial balance, which is given in the question. You can also verify. I've already sent you the question. Now, let's move on to adjustment number three. let's move on to adjustment number 3, your favorite adjustment, adjustment number 3. Adjustment number 3 is taxation. Taxation, just look at here. You just need to make the packet of total tax. You just need to make the packet of total tax, okay? And total tax means sum of two taxes, current tax and deferred tax, current tax and deferred tax, current tax and deferred tax, okay? Now the balance relating to tax in the trial balance relates to the under over provision from the prior period. Okay, wait. They have openly told you that the balance in the trial balance is under or over provision. Now what's the identification? Come on, what's the identification of under or over? Under provision is expense, it comes on the debit side. Under provision is the expense, it comes on the debit side. Over provision comes on credit side. Okay, let's see. Okay, tell me. See, the tax is on the credit side, that's why it's over provision. Okay, this is income. The tax thing is on the credit side, that's why it's over provision and it's your income. Okay, so one thing is over provision 130, and the second thing, now the tax estimate for the year ended 30th June. This year current tax liability is 2.1. So you can make your own packet. Wherever you are sitting, you can make your own packet. First of all, you will write the estimated current tax. You will add the estimated current tax, that is 2.1 million or 2100. 2.1 million or 2100. 2.1 million or 2100. The second thing, you will deduct as over provision. Over provision is deducted because it's an income. Okay, so these two things will make your total tax. Okay, then the third thing. Now, in addition to this, there has been a decrease. In taxable temporary differences of 2 million in the year. See, decrease in taxable temporary difference, not deferred tax provision. This is taxable TDs, taxable temporary difference. Let's look at here. If you multiply this taxable TD with tax rate, if you multiply this taxable TD with tax rate, then you will get DTL. Open your ears. If you multiply this taxable TD with tax rate, you get deferred tax liability. Right? Okay, right. Now, so the taxable TD are decreasing by 2 million. See, 2000 is the decrease in taxable TD times what's the tax rate? It's 25%. So finally, decrease in DTL is 500. Now just let's make the entry. In seconds you can make the entry. The entry will be DTL debit 500, and this is decrease in DTL, so obviously P&L credit, it's an income. Decrease in deferred tax liability is your income. Yes, increase in deferred tax liability is expense. Decrease in deferred tax liability is your income or credit, and increase is your expense. So in this question you have a deferred tax income. So almost everything is done. In this part. You can have a look. Now let's write it. Okay, what's your this year current tax liability is 2100. Your over provision is 130. Your over provision is 130, right? Okay. Now, deferred tax credit is how much? Let me make the entry here for your relevance. 2000 times 25% decrease in DTL. So DTL debit 500 and PNL credit 500. Okay. Now, as this is your income, that's why it will come as a negative number. Tell me what's the final answer. 2100 minus 500 is 1600, and then 1470. 1470. 1470. Come on. 1470 is your final answer. Okay. Now, what is relevant for you right now? You are doing income statement. Right now you are doing income statement. So this, only this number is relevant for you. This is your total tax expense. This is your total tax expense. You don't need to discuss, you don't need to even discuss about the SOFP things. You don't need to even discuss about SOFP things. Leave it, forget it. You don't need to discuss about SOFP things. Okay. Okay. So we'll be posting this 1470 in the text, and soon I'll post, don't worry. Now let's move to adjustment number 4. Let's move to adjust. Yes, this is learning and this is routine thing. This is a very routine thing. Very famous adjustment, convertible loan notes. Sorry, convertible loan notes. Please look at here. Dugan Company issued 5 million 6% convertible loan notes on 1st July X7. The date is very, very important. The date changed everything I'm telling you. So this date means at the beginning of your accounting period, you issued loan notes at the beginning of your accounting period. You issued loan notes at the beginning of your accounting period, right? So that means in front of you they issued the loan notes. So you, first of all, the first and very famous thing, you need to split debt and equity. You need to split debt and equity. Please, need your energy now. Then it is written, interest is payable annually in arrears. That means on the last day. On the last day, it's routine. These bonds can be converted into one share for every two. These conversion terms are not needed. This is only needed in EPS question. This is only needed in diluted EPS question. Right now, no relevance. Just read it. On 30th June X9, that means total 2 years. 1st July X7 to 30th June X8, and then 30th June X9. Only 2 years are involved. My dear boys and girls, only 2 years are involved. Similar loan notes without conversion rights incur interest at 8%. Okay, see, this is the market. 8% is the market interest rate, very relevant. Why? We have got the loan for 6%. We have got the loan for 6%, but in the market, the interest rate without these conversion terms are 8%. So definitely the difference of 2% is because of the conversion terms, because of that equity option, Okay. Now, Dugan Company recorded the full amount. See this. They have booked the complete amount in the liabilities and has recorded the annual payment made on 30.3 million in finance cost. This is very routine. In all, if you have done 10 questions of final account, this is routine. Normally, physical interest examiner already books. Examiner already booked physical interest, physical cash payment of interest in finance costs. So we need to adjust the remaining amount. We need to adjust the remaining amount. Don't worry. Now, these are the discount factors. So this is irrelevant. 6% discount coupon rate, irrelevant. Yes, this is relevant. You always do in your SOFP, all liabilities and all assets are discounting using market interest rate. in your SOFP, all assets and all liabilities are discounted using market interest rate. So once again, here you will be doing the discounting using market interest rate. So now what are the steps? What are the steps of to solve this? Look at me. The first thing, the the first thing is look at here. Treat this transaction as a loan. Treat this complete transaction as a loan, okay? And identify the cash flows. So how many cash flows you need to pay? Only two types of cash flow, the physical interest and principal amount. Interest and physical amount. Okay, look at here. 5 million is 5,000. 5 million is 5,000 times 6%. 5,000 times 6% is 300. 5,000 times 6% is 300. So every year you have to give 300 physical interest. Every year you need to give 300 physical interest. And at the end of year 2, you have to repay the principal amount of 5,000 as well. At the end of year 2 you need to repay the principal amount of 5,000 as well. Okay, so let's plot the cash flows and let's do discounting. It's very easy, it's very routine. Okay, see, this is your accounting period, 1st July X7, and this is 30th 1st July X8 and 1st July X9. So one interest here, and one principal here. Can you see the screen? Now this is going to be year 1 and this is year 2. So at the end of year 1 only 300 cash flow, and at the end of year 2 300 plus 5,000, 300 plus 5,000. Okay, let's do it. 300 times, you can also do it if you want to, 0.926, it's 277.8. then you do 5,300 times 0.857, 4542, 4542.1. Okay, let's add it. It's I think 4820. Now just think, do it with logic. This is 4820. Now just think, if you treat this transaction as a loan, just from the investor's point of view, investor has invested 5,000 today. Investor has invested 5,000 today, and if you treat this transaction as a loan, investor is getting only 4820 in terms of present value. So there is a negative NPV, there is a negative NPV. So nobody will invest, but the investor has invested, and he's very happy. So why he has invested? Why he has invested in this deal? Because of the equity option, because he has invested in equity as well. So what's the amount of equity option? Can you tell me? It's I think 180. 180 is the equity option. Okay, 180 is the equity option, right? So wait, just have a look. Come on, quick look. Now let's do accounting with using 3 steps. I hope you remember the basic accounting. What entry should have been made on the day 1? See, debit bank 5,000, the loan amount is 4820, and the equity is 180. This entry we should have made. The first entry we should have made, the accountant should have made. But go and read the question. What accountant actually did? He recorded the complete amount as a loan. He recorded the complete 5,000 as a loan. So accountant made the entry debit bank 5,000 and credit loan 5,000. Accountant made the entry debit bank 5,000 and credit loan 5,000. So now you tell me what should be the correcting entry. The correcting entry, you need to reduce the loan by 180, and you need to increase the equity option by 180. Now for your information, this is a change in equity. See, this is, you just look at here, you just issued a convertible loan note. You just issued in this current year a convertible loan note. This will bring a change in equity. This will bring a change in your total equity. So it will be reported in SOCHI. This thing we need to report in SOCHI, statement of changes in equity. This thing we need to report in SOCHI, statement of changes in equity. Okay. Look at here. Look at here. The question is not over yet. Little thing is left. Little thing is left, and I'll teach you with double entries. Now, what's this? In my class, I sometimes say this equity option will now go in the freezer. This equity thing will now go in the freezer, but be careful about the loan liability element. Be careful about the liability element. How did you calculate? Now question yourself. Now question yourself. How did you calculate? How did you calculate this liability element? How did you calculate this liability element? Through discounting. Through discounting. How did you calculate? See this through discounting. So you know, whatever rate is used for discounting, the same rate is used for unwinding. Whatever rate is used for discounting, the same rate is used for unwinding. Okay, so we did discounting using market interest rate. We did discounting using market interest rate. So the same rate we need to use, same rate we need to use for unwinding as well. Now look at here. Your liability, your loan element is 4820. Now, what's the interest rate is 8%. See, you did discounting with 8%. Come on, do it. 48, let me make the entries for you. 4820 times 8%. Come on, come on, come on. 4820 times 8% times 0.08. It's 386. I'm just doing round off. It's 386. Okay. Interest expense debit 386. What's the physical interest out of this? We have to pay 300 every year. And then the loan extra amount of 86 will be added in loan. This entry accountant should have been made. This entry accountant should have been made for interest. This entry accountant should have been made for interest. Okay. But what entry he did make? What entry he made actually? He only, look at the, go and read the question, go and read the question. He only made the entry of physical interest. He only made the entry for physical interest, that is debit interest expense and credit cash. Debit interest expense and credit cash. Now, can anybody tell me what will be the correcting entry? Can anybody tell me what will be the correcting entry now? This entry he should have made, and this actually he made. So the cash is already recorded, plus 300 is also recorded. So now the difference is 86. So the entry, the correcting entry, the adjusting entry is this now. Okay. So now that's the big picture of the question, of the solution. See, everything in front of you is solved. Only you need, look at me, only you need to adjust just two entries, the right tick one, the right one. I've just ticked. I have just ticked those two entries. Only you need to post those entries, and that's it. Done. That's it. If you just post these two entries, your work is done. Your work is done. That's it. And one more thing, no need to post anything in SOFP. No, that means the loan thing, loan items you don't need to adjust, because you don't need to prepare SOFP in this question. You don't need to prepare SOFP in this question. Okay. So simply income statement and SOCHI things. Sir, what are those things? Interest expense will be adjusted. Interest expense will be adjusted in income statement, and that equity thing, that equity option will be adjusted in SOCHI. That's it. That's it. let me post you the two things, the two last two, adjustment 3 and 4. Adjustment number 3 is 1470 tax, and this is 86 interest expense. Okay, let's post. Tax expense is 1470, and you have interest expense of how much? 86, right? You need to adjust interest expense of 86. See, tax expense is 1470, tax expense is 1470. See, I've adjusted, and 86 in the finance cost, 86 in the finance cost. Okay, I'm doing real time updating. I'm doing real time updating so that we don't forget anything, so that we don't forget anything. Okay, let's move to adjustment number 5. It's total learning, because it's IS 23. It's IS 23. Okay, and if somebody wants to revise IS 23, it's on my YouTube channel. IS 23 is on my YouTube channel, but it's in Urdu Hindi language, not in English language. Okay, now Dugan Company, Dugan Company began, come on, use your brain. Dugan Company began the construction of an item of property on 1st of July, 1st of July, the very first day of your accounting period. So the conditions of capitalization of interest has met. See, work should be started. Work should be started. Work should be started. Okay, and they have started the work, so the condition has met. From 1st July you can capitalize the finance cost. You can capitalize the finance cost if this is the qualifying asset. If this is the qualifying asset, then yes, you can capitalize the finance cost, because the work has been started. Now I hope you remember the conditions, which was completed. See, very important, which was completed on 31st March x8. That means after 9 months the project is done, the project has been completed. Now listen, the day you complete the project, from that day onwards you cannot capitalize the finance cost. You cannot record finance cost as an interest from that day. After that day, finance cost is simple in expense, is your interest expense. Okay, so according to this data, you can only capitalize 9 months. According to this data, you can only capitalize 9 months. That's it. Okay, be very careful. You cannot capitalize 12 months interest expense in this question. Now see what they have done. A cost of 32 million was capitalized. Okay, no issue. This included 2.56 million being see their words, being a full 12 months interest on a 25.6 million loan, 10%. This is wrong. This is wrong. Why did this guy capitalize 12 months interest? Only 9 months interest capitalization is allowed. Why? Because after 9 months the project is completed. The project is completed, and once the project is done, you cannot capitalize any further. You cannot capitalize any further interest cost. So now just look at the adjustment and solve it. This 2.56 million means 2560. 2.56 million means 2560 interest, and this is for 12 months. This is for 12 months. So you can only capitalize 9 months. You can only capitalize 9 months, but this guy has capitalized total 12 months. So you need to reverse 3 months. You need to put 3 months interest in P&L. You need to put 3 months interest in P&L. Okay, so take out your calculator. Just simply do it. 2560 times 3 upon 12. 2560 times 3 upon 12 will be transferred to income statement. Simply 2560 times 3 upon 12 will be transferred to income statement, finance cost. That's it. This is the first solution. Now one more thing, only a brilliant guy can think. Only those guys who are not sleeping, they can think. See, Just think and look at me. They have over capitalized. They have done some extra capitalization of finance cost. That means they have increased the value of their asset by mistake. They have increased the value of their asset by mistake. So now when they have increased the value of their asset, that means they have calculated extra depreciation as well. We all know when the value of asset goes up, the depreciation expense also goes up. So that means they must have depreciated extra depreciation. They must have booked extra depreciation in the last 3 months. Let's have a look. Let's have a look. Dugan Company also recorded 0.4 million in operating expenses. Don't forget, representing depreciation. See, they are booking depreciation in operating expenses, so we will also adjust depreciation in operating expenses, okay? Because examiner has told us openly on the asset for the period from 31st March X8 to 30th June X8. Now what's the life? 20 years is the remaining life. 20 years is the remaining life. So two things I need to adjust for this adjustment. Just two things. Number one, the extra finance cost which they have capitalized, I will transfer that in P&L, number one. And number two, I will reduce the depreciation because they have overbooked the depreciation. They have overbooked the depreciation for that extra asset. That's it. Two things. 30 seconds you have to think over it. This is technical adjustment. This is not easy. And plus this is a non-routine IS. That's why it may be technical for students. Look at here. This is your accounting period. 1st July. See, I have made the boundaries. 1st of July to 30 June. Okay. The first 9 months construction is done. So that's why only 9 months interest can be capitalized. See, according to IS 23, once construction of qualifying asset is completed, we need to stop capitalizing interest from that date. That's why I need to transfer last 3 months interest in P&L. See, this is the theory part you need to identify. Okay, so what was the interest of 12 months? Come on, tell me, what was the interest of 12 months? 2.56 million. 2.56 million you can write as 2560. This is for 12 months. If you do it 3 upon 12, so 2560 times 3 divided by 12 gives you 640. The first thing, come on, increase your finance cost by this amount. Transfer this amount in income statement. You don't need any entries. Transfer this 640 in the income statement as a finance cost. Transfer this 640 in the income statement as finance cost. Okay, the first thing. Now the second thing, just use your brain and think over it. Now the second thing, please. When this stupid guy has increased the asset by 640, when this guy booked extra asset, extra capitalization, extra asset by 640, so that means on this 640 they must have booked extra depreciation. On this 640 they must have booked extra depreciation, which we need to reverse, reverse for 3 months. So now let's also, we need to reduce depreciation expense because accountant overcharged the depreciation expense. How? 640 is the extra asset amount and the life is 20 years. So if you divide 640 divide by 20, you will get 1 year depreciation. 640 divide by 20 years, you will get 1 year, but they have only booked 3 months extra. They have only booked 3 months extra. 8. Okay, so we need to adjust this 8 depreciation. We need to adjust this 8 depreciation. That's it. 8 depreciation. That's it. Okay, and you need to reduce depreciation expense. You need to reduce, and they have clearly told you that depreciation expenses are adjusted in this question. Depreciation expenses adjusted in operating expenses. So simply decrease the operating expenses by 8. That's it. Have a look. 30 seconds. Come on. 30 precious seconds. 30 precious seconds. You can see the question. Okay, let's adjust it without wasting the time. Let's adjust it. 640 I'll adjust in finance cost and 8 in operating expenses. 640 I'll adjust in finance cost and 8 in operating expenses. Have a look. Now let's do the last adjustment. Last adjustment is again repeat. I have seen 3 to 4 times in your past paper and this has come again. This is the credit controller fraud, the very famous credit controller fraud. See what has written. It has been discovered that the previous financial controller of Dugan Company engaged in fraudulent financial reporting. Currently 2.5 million of the trade receivables has been deemed to not exist and requires to be written off. Of this, 0.9 million relates to the year ended 30th. That means current year. In the current year, that guy did the fraud of 0.9 million, and with 1.6 million, with 1 point relating to the earlier periods, prior periods. I hope you remember IS 8. The name of IS 8 is changes in accounting policies, changes in accounting estimates, and prior period errors. This topic is related to prior period errors. And we all know that prior period errors are adjusted retrospectively in retained earning. Prior period errors are adjusted in opening, retained earning. Prior periods error are adjusted in opening, retained earning. Okay. Have a look. Have a look. I'll tell you the story. I'll reform this part as a story. I'll tell you a story. Don't worry. You just have a look. Now listen. Look at here. Look at here. I'll tell you the story. Let us say this is your year ended 30th June X8. Please be active. I need your energy. It should be two-way traffic. Please. At the end of 30th June X8, we have many trade receivables, but in that trade receivable, there is a trade receivable of 2.5 million. 2.5 million means 2,500. There is a trade receivable of 2,500. Okay. And we just got to know that our credit controller ran away. Our credit controller ran away to a foreign country and he is lost now. So when we investigated, we came to know that this trade controller was doing this credit controller was doing fraud with us. What fraud? He used to take cash from customers and he used to put in his own pocket. Repeat. This what this credit controller was doing with us. He used to take cash. He used to collect cash from customers and he used to put in his own pocket. He didn't deposit the amount in the company's account. So this is a fraud. So when we came to know, we started taking action, but that guy ran away. That he ran away. Okay. So now we can't do anything. We can't do anything. Plus we are uninsured as well. We can't do anything. Plus we are uninsured as well. So now get ready to book loss. Get ready. Be prepared to book loss. Okay. Somebody cheated you. Okay. So now it's like now you need to write off these receivables because definitely customers won't pay again. Customer has already paid us one time. So now what entry we'll make? Look at here. We'll write off the receivable. We'll simply credit the receivable by 2,500. Now We have started calling the customers. Then when did he take cash from you? So out of this 2500, see, out of this 2500, 0.9 million is taken this year, and 1.6 million he took last year. So zero point 0.9 million will go in operating expenses of the current year, that is 900. 900 will be booked in operating expenses or P&L of the current year. And look, listen my words, this 1.6 million or 1600 is the expense of last year. This 1.6 million or 1600 is the expense of last year. So we'll go in the last year, and last year we'll book this expense. When we book this expense last year, our last year profit will go down. When we book this 1600 as an expense last year, our last year's profit will go down. And when our last year profit will go down, our opening retained earning will go down. When our last year profits go down, our opening retained earning will go down. So this, see the entry, we'll debit the retained earning by 1600. So this is the only entry. This is the only entry you need to make. This is the only entry you need to make. That's it. This is the only entry you need to make, and everything is done. Okay, so just post this entry and you will, everything is done. Now the question is, sir, this operating expenses will adjust where in the income statement? Operating expenses are adjusted in income statement. Okay, and this retained earning, opening retained earning adjustment is done in SOCHI. Opening retained earning adjustment is done in SOCHI. Okay, so boys and girls, if you have any problem, if you understood this part, please hit a message. If you understood this was the old part. This is from old past papers. Okay, so if you got it, please write a message. Your opening, if you want to do without double entry, opening retained earning will be reduced by 1600 and operating expenses will be increased by 900 simply. No need to make entry. Entry is not mandatory. So now let me post this in operating expenses. See, you need to increase the operating expenses by 900. Okay, and you need to reduce the opening retained earning by 1600. Okay, now let's have a look. Now there is nothing difficult in the question. Overall question, no difficult thing. Zero difficulty level now. Just you have to make the statements. Only one share issue, one basic share issue, F3 level. Basic foundation level transaction is there. F3 level transaction is there for you. F3 level transaction is there for you. That's it. Let's do it. Come on. What the last transaction says: on 1st of November X7, Dugan Company issued 1.5 million, means 1500 shares. 1.5 million means 1500 new shares at their full market price. See, this is a full market price issue, cash issue, new money is coming to you of 2.2. And if you go to the question, the face value is 1. The face value in the question is $1. So you can easily calculate the share premium thing as well. You can easily calculate the share premium. The proceeds were credited to a suspense account. The proceeds were credited to a suspense account, See, that this is a clear indication that examiner has made the half entry. So not a big deal. We'll do it. Let me make you the entries. Okay, see how many shares? 1500 new shares. Okay, look at here. So 1500 shares, and these are not free issue, these are with money. So 1500 shares, and the per issue cash is 2.2. 1500 times 2.2, come on, 50, this is all F3, this is all F3 level. 1500 times 2.2, debit bank 3300. Now whenever you issue share, you record, you increase your share capital with face value, you increase your share capital with face value. So 1500 times 1 is 1500, and what's the difference? I think is 1800. Okay, so this entry you should have made, this entry you should have made, but it's written here, he did just debited the bank, and he forgot to credit anything. The accountant just debited the bank and he forgot to credit anything. So bank debit, okay, bank debit and suspense account credit. Now you tell me what's the third entry? Still the entry is not needed, but still make the third entry. You will close this suspense account, you will debit this suspense because suspense is already on credit side, and you will record this share capital 1500 and share premium 1800. Can anybody tell me in which section of the financial statement do we need to adjust the share issue? In which section of the financial statement do we need to adjust the share issue? Can anybody tell me in which section of the financial statement do we need to post this entry? Tell me. SOCHI, yes, very good. SOCHI. It is posted in SOCHI. SOCHI, statement of changes in equity. Statement of changes in equity, yes. Now, we have already posted everything. Let's all of us calculate the income statement. 43,200, 43,200 plus 2,700. It's 45,900. See. Then you have cost of sales 21700 plus 1500 is 23,200. You also recheck. Okay, now the GP is 22,700. Okay, now let's do operating expenses. 13,520 plus 120 minus 8 plus 900. This is 14532. 14532 is the operating expenses. Then can you tell me profit from operations? Now, what is your 1240 finance cost plus 46 plus 86 plus 640 2012. I think there is some investment income ready made in the question. There is some investment income. Go and pick. Go and pick. There is some investment income ready made in the trial balance. Yes, here it is. Investment income is 120. Investment income is 120 ready made in the trial balance. Okay, let's simply post it. No adjustment required for investment income. Okay, so let's calculate PBT. 6276. Okay, this is your PBT, and then you have tax of 14. What's your PAT? Okay, so very easy. These workings are not difficult. You have income statement and profit is 4806. I hope you got it. This is not a big deal, just number crunching. Got it? Got it? Have a look. Now, the next statement is SOCHI, statement of change in equity. I have made one extra column just for your satisfaction, the total column. Now, total column is not required. In the latest examiner solutions, total column is not required anymore. Okay. So, how we make SOCHI? Just we make columns in SOCHI. It's very easy. No tension, please. Share capital, share premium, revaluation reserve, or you have convertible loan note equity option, and then retain earning and total. These are the columns. These are the columns. And simply just do one thing: copy paste opening balances. Simply just copy paste opening balances from the trial balance. Simply copy paste. So in the question, opening share capital is given. There is no balance of share premium. There is no opening balance of share premium. Yes, there is a balance of retain earning. No opening balance of convertible loan note. So if I make proper total column, let's do it in this way. Okay. Now, if you have made SOCHI in your life, so whenever there is a prior period adjustment, whenever there is a last period, prior period adjustment, first always solve this. So hope you remember there was a prior period error of 1600, that fraud, that credit controller fraud reduced the retain earning by 1600. And first of all, write the revised balances. See, wait, Azan. Now listen, whenever you see a SOCHI, Just first of all, check, is there any prior period adjustment? Yes, in this case, there was a prior period adjustment, the credit controller. So always adjust that thing and write the restated balance. See, I have restated the balance. Now, from this point, your normal SOCHI is starting. From this point, you are going to start your normal SOCHI. In your normal SOCHI, normally few things comes, few things, just remind few things. Number one, the right issue or the cash issue. The right issue or the cash issue. Is there any right issue in this question or cash issue? Yes, the full market price issue. So simply adjust it, the cash issue. What were the numbers? I think 1500 was the share capital and 1800 for the share premium. So the total impact is 3300. Okay, you increase the share capital by 1500, you increase the share premium by 1800, so the total balance is 33. Okay, and again I'm telling you, there is no need for this total column. This is extra, this is extra. Now there is no need in exam, no need to make it. Okay, the second thing which comes in the SOCHI is bonus issue. There is no bonus issue, ignore it. The third thing which comes is total comprehensive income, or you call it profit. Yes, there was a profit in this question. There, in every question there is a profit. Profit is 4806. See, we have calculated the profit. Profit will go in retained earning 4806, and it will increase your total equity as well. Okay, the fourth thing is ordinary dividend. Is there any ordinary dividend? No ordinary dividend in this questions. No ordinary dividend in this question. Okay, then the fifth thing is transfer entry. Sometime, I hope you remember this entry: revaluation reserve debit and retain earning credit. Revaluation reserve debit and retain earning, the transfer entry in IS 16. No such revaluation things in this question, so ignore it. And the fifth and one last thing, sometime it comes, is the convertible loan note. Yes, this year you issued convertible loan note. This year you issued convertible loan note. So because of convertible loan note, there is a movement of equity reserve. Okay. I think it was 180. I think it was 180, and it will increase your total as well. Okay. So these were all the adjustments of SOCHI. Now simply calculate the balance. Twelve two hundred plus 1500. 12,200 plus 1500 is how much? Come on, come on. 12,200 plus 1500 is 13,700. This one, then 1,800. Then you have 33,800. 38,606. Okay, with 180, and this total is 13,700 plus 1,800 plus 38,606 plus. Okay, that's the end of your two major requirements. That's the end of your two major requirements. I hope you understood it. Did you understand it? Please write a message. If you understood this, write a message, please. Okay, now there is a small 3 marks requirement. I request you to do it yourself. There is just a full market price issue. It's very basic. Just a full market price issue. In that requirement, you need to compute weighted average number of shares. Make a timeline, write the opening shares and the full market price issue, and then you need to calculate weighted average number of shares and simple basic EPS. Okay. After this break, I'm giving you a short break of 7 to 8 minutes. After this break, we'll do one more question. We'll do one more excellent question, which is recommended in the last examiner report as well. Examiner recommended that question as well to practice. Okay, so we'll be doing that question as well. So let's take a break, 8 to 10 minutes, right? Thank you. Okay. Let's move on to the next question. Sent you this question already on your WhatsApp group. So the name of this question is Haverford. Okay. In this question, you have to do number one, the profit reconciliation first, then SOCHI, and then SOFP, proper statement of financial position, SOFP. Okay. Now let's you have already given a trial balance. See, the trial balance is ready-made given to you in note number one. I must say note number one is ready-made. Okay, one more thing. See what is written. Draft profits. They have already calculated one profit. See this 2250. This is the profit. Already they have calculated a profit which you need to adjust. Okay. So adjustment number one is same as in the last question, the convertible loan note. Very simple. Now let's identify the basic marks. First of all, your year end. Always in any final account consolidation question, you need to identify the year end. So year end is 31st of December X7. 31st of December X7. So that means starting is 1st January X7. Okay. Now on 1st of January X7, Haverford Company issued $80,000 $80,000 times $100. 80,000 times $100, it makes 8 million. And 8 million means 8,000. In our language, 8 million means 8,000. See, in the trial balance, they have recorded already 8,000 as a loan. 4%, this is the coupon rate, the physical interest rate. Convertible loan notes. The loan notes can be converted to equity shares on 31st of December X9, 3 years. January X7 to December X7, 1 year, then December X8, and then December X9. So in the last question, it was only 2 years. But in this question, it's 3 years. In this question, it's 3 years. It's 3 years. Okay. Now, listen. The loan notes can be converted into equity shares or redeemed at par on the same date. An equivalent loan note without the conversion rights would have required an interest rate of 6%. See, this is the market rate and this is the coupon rate. So this is irrelevant. The discount factor of coupon rate is always irrelevant. Don't touch it. Don't touch it. Okay. So interest is payable again annually in arrears and on 31st December each year. That means the last day. The annual payment has been included in the finance cost for the year. See, once again, the cash finance cost has already been adjusted. The cash finance cost has already been adjusted. That means that means already been deducted in arriving at the profit. So cash finance cost, interest paid, has already been adjusted. We need to adjust the remaining amount as we did in last question. Okay. So now, very simple. They have, listen, look at here. They have issued loan note in front of you in the same accounting period for which we are doing the question. The company has issued loan notes in the same accounting period for which we are solving this question. Okay. So yes, you need to split debt and equity. And what's the procedure? The routine procedure is, first of all, assume this transaction as a pure loan. First of all, assume this transaction as a pure loan and identify the cash flows. So there are two types of major cash flows in these transactions. One is interest and one is principal. Okay, let's do it. So 8,000 times 4%. 8,000 times 4%, 320 is the physical interest. 8,000 times 4%, 320 is the physical interest. Look at the screen. So 320, 320, 320, plus 8,000. See, these are the cash flows. 3 years you have to give the interest, and the last year you have to give interest plus principal. Okay, so here you have everything is ready made. You have to help me out. 320 times C, 6% discount factors I have already written. Okay, let's do it. 320 times 0.943. 0.943 is 301.7. Okay, then you have 320 times 0.890. Okay, then you have 8320 times 0.84, 6988.8. Okay, let's add three of them. 284.8 plus 301.8 to 7576. Just rounding off, 7576. Now what's the, listen, what's the initial investment, initial transaction amount was 8,000. So now if you see this, it's coming negative NPV. If you see there is a negative NPV coming, but still that investor has invested, so that means that investor has not invested in pure loan notes. There is something other thing as well, that is equity. So how much is the equity? 8,000 minus 7576. Okay, this is your equity option. This is your equity option, right? Okay, done. Now let's make the entries. The three-step approach, the three-step simple approach. Which entry you should have made? You should have made, you received the bank 8,000, you received the cash 8,000, and how much is the loan? Loan is, I think, 7576. Okay, 7576. The equity thing is 424. So this is the entry. Look at here. This is the entry which they should have made. This is the entry which they should have made. But what they did made, go and check the TV. Go and check the trial balance. They record the complete transaction 8,000. They record the complete transaction 8,000 as a loan. Go and check in the trial balance. So now what should be the third and the correcting one? The correcting one will be loan, debit loan 424, and credit equity option by 424. This is the first correcting entry which you need to make, and this will be posted to SOCHI as well. This will be posted to SOCHI, statement of change in equity as well. And now, yes, this is the question. In this question you have to make SOFP as well. In this question you need to make SOFP as well. So definitely you need to reduce the loan as well. You need to reduce the loan as well, and I'll be doing this in front of you. First thing done. Now the second thing. With this equity option, once you created this equity, put it in the fridge. Don't touch it for 3 years. But with this loan thing, this loan element is calculated through discounting. So whenever you do discounting, you need to do unwinding, and with the same interest rate. The interest rate which is used for discounting, the same interest rate to be used for unwinding as well. Okay, so let's do it. Your loan is 7576, and the interest rate used for discounting is 6%, I think. So 7576 times 0.06, that is 6%, 454 or 455. Okay, so interest expense, debit interest expense 455, out of this, how much is the cash? Physical interest is 320, and the difference between 455 and 320 is 135. Okay, so this entry accountant should have made, this entry accountant should have made for interest, this entry accountant should have made for interest. But what he did make, he did make only 320. Okay, so interest expense debit 320 and cash credit, the physical cash, the physical finance cost has already been recorded. So now tell me, what's the final correcting entry? What's the final correcting entry we need to adjust now? This is, I think, 135. Yes. So interest expense debit 135 and loan credit 135. Okay, so just two entries. Listen, just pose the two entries with the right tick and you will your adjustment is end, your adjustment is done, you will get full marks. Just pose the two entries with the right tick and your adjustment is done, and your adjustment is done. Okay, let me adjust one thing here right now. Loan, in this adjustment, loan is decreasing by 424, and this, in this, loan is increasing by 135. Let me adjust on the TB. See, this is the loan. 424 is less 424 and add 135. Okay, why I've done this? So that I don't forget in the end, so that I don't forget in the end about the posting of this, right? Okay, now one more thing. Sir, where will we post this interest expense? This additional, look at here, this additional, or I say extra interest expense, examiner has not already adjusted in the profit. This interest expense, we can say examiner forgot to book. So this is an expense, and when we book this expense in the profit reconciliation, we'll decrease the profit. When we book this interest expense in the profit reconciliation, it will decrease the profit. So don't forget, this 135 will decrease your profit. One more thing, this thing will go in SOCHI. This thing will go in SOCHI, the equity option thing, will go in SOCHI. Okay, now the next adjustment is important. It's IFRS 15. I taught you today IFRS 15. This will, you can have a recap of income statement as well as SOFP. Now be with me. For construction accounting, always check the contract is in profit or loss. Now, if the contract is in profit, then book that profit according to stage of completion. If the contract is in profit, then book that profit according to stage of completion, okay? Now, but whenever you are going to check the contract, always use total revenue and total estimated, total numbers. Always use total revenue and total estimated cost. You will find things ready-made. During the year, Haverford Company entered into a contract to construct an asset. See, the good news is during the year. That means we signed the contract this year. This is not the old contract. This is not the old contract like the previous question, Dugan Company. See, we don't need to make two P&L asset. We don't need to do two P&L asset, and we don't need to do cuttings and all. This is easy part now. Comparatively, it's easy because the contract has started in this year. Okay, so one P&L is enough. During the year, Haverford Company entered into a contract to construct an asset for a customer satisfying the performance obligation over time. The contract had a total price, total revenue of 14 million. Okay, and the cost to date, just interpret it. Cost to date means cost incurred to date. Cost to date means cost incurred to date is 1.9 are included in the above, and cost to complete is 7.1. Now if I tell you to calculate total estimated cost, if I ask you to calculate total estimated cost, I taught you today total estimated cost means cost incurred to date plus cost to complete. Total estimated cost equals to cost incurred to date plus cost to complete, so it becomes 9 million. Okay, so now easily you can see the contract is in profit. The contract is in profit. You can see. Check it out. The contract is in profit. Why? Your revenue is 14 million. Your revenue is how much? 14 million, and your total estimated cost is 9 million. Okay, so simply the contract is in profit. Now at 31st December X7, the contract is estimated to be 40% complete. Thank God, ready-made SOC is given. Ready-made SOC, stage of completion is given. You don't need to waste your time for SOC. Now, Haverford Company has received, amount billed and received is 1.4 million from the customer and is shown in the trial balance. This thing will go in SOFP calculation. This thing will go in SOFP calculation. Hope you remember contract asset and contract liability. Contract asset and contract liability. Giving you 20 seconds to look at it. Have a look. Have a look and make a strategy in your mind. You have done many questions. Even in MCQs, you have done this. Now, okay, see, this is the year end. Always at the year end, we need to check the contract is in profit or loss. Contract is in profit or loss. And for this, check total numbers. 14,000 is the total revenue. And this 1900 plus 1700, 7100, 9,000 is the total estimated cost. So the contract is in profit. Okay. So whenever your contract is in profit, then book revenues and cost according to stage of completion. Let's do it. See this P&L for the year ended 31st December X7. Your total revenue was 14,000 and stage of completion is 40%. So 14,000 times 40% is 5,600. Okay. And your total estimated cost is 9,000 times 40% is 3,600. Come on. 2,000. Okay. Now you can solve this question in two ways. You can adjust this question in two ways. Number one, in the profit reconciliation question, you can add this and you can subtract this. You can add revenue and you can subtract the cost. Automatically the profit will be adjusted. And the second option is you can directly adjust this profit. You can directly add this profit. Okay. In this question, you don't need to make the complete income statement. In this question, you don't need to make the complete income statement. Only you need to adjust the profit. Only you need to adjust the profit. Okay. So for profit adjustment, you can directly add 2,000. This is enough. And one more style, add 5,600 and deduct 3,600. Add 5,600 and deduct 3,600. Okay. This thing is for income statement. This thing is for income statement, which we have done. Now one more thing which you need to do for SOFP. One more thing which you need to do for SOFP. See, for SOFP, everything must be as at. For SOFP, the first dialogue, everything must be as at. So cost incurred today, ready-made given in the question is 1900. Cost incurred to date is 1900. Add profit recognized to date. See how much profit we have recognized. How much profit we have recognized? It's 2000. Okay. So this cost we need to recover from the customer, this profit also from customer. So total we want from customer is 3900. 2000 plus 1900. 2000 plus 1900, total amount we want from customer is 3900, but customer only paid 1400 to us. You can go and check the adjustment. Customer only paid 1400 to us. So how much receivable or how much contract asset is left? I think it's, and as this is a positive, this is contract asset, or you, and this will be posted in current asset number. This will be posted as a current asset in SOFP. This will be posted as a current asset in SOFP. I hope you got it. This is a routine transaction. You must know now. Exam is near. Now, did you understand? Did you understand? Please tell me. Did you understand? Note number 3. Note number 3 is routine bonus issue transaction like F3 level, foundation level. Listen, Havard company made a 1 for 5 bonus issue on 31st December X7. This is exactly F3. It comes in F3. We all teachers teach, which has not yet been recorded. See, not already been recorded. That means we are the one to record. We are the one who are going to record. In the above trial balance, Havard company intends to utilize the share premium as far as possible in recording the bonus issue. I hope you remember the basics. Whenever you want to do bonus issue, first of all, use your share premium account. First of all, use your share premium account. And once your share premium basket is empty, then go for retained earning. Okay, right? Now, first of all, see how much is the existing, see here, how much is the existing share capital is 20,000. See, and your share premium is 3,000. Can you see these numbers? Your existing share capital, open your eyes. Your existing share capital is 20,000 and your share premium is 3,000. Okay, let's do this entry. Let's do this like F3. We'll do it like F3. See, you have right now you have share premium of 20,000 and share capital of 20,000 and share premium of 3,000. Okay, now company just did 1 for 5 bonus issue. Can you tell me what do you mean by 1 for 5? 1 for 5 means 20%. 1 for 5 means 20%. So we have already issued 20,000 shares. We'll issue 20% more. So 20,000 times 20% is 4,000. So the new shares we are going to issue is 4,000. See the entry. New shares we are going to issue is 4,000. Okay, done. Now, whenever any company in the world issues shares, they credit the share capital with face value. See, so 4,000 shares, face value is $1. 4,000 shares, the face value is $1, so 4,000 times $1 is 4,000. Okay, so share capital, you just credited the share capital with 4,000, right? Now in the question it is written clearly, use share premium first. So now debit the share premium by 3,000. Is this entry balance? The answer is no. Now use the retained earning. By 1,000. Okay. So this is the entry you need to make. And I'm sure you know that we post all share issues entry in SOCHI. We post all share issue, right issue, bonus issue, all entries in SOCHI. Okay. Okay. Have a look. Okay. Now next adjustment, the most famous adjustment IS 16, the most famous adjustment of F7 FR paper IS 16, revaluation. And I hope you remember these dialogues of your teacher. Whenever you see a revaluation or impairment question, whenever you see a revaluation or impairment question, always look at the date of revaluation of date or date of impairment. Always look at the date of revaluation or date of impairment. Very important thing. Okay, now let's see. Haverford Company's property had previously been revalued upwards. That means in past there was an upward revaluation. And what's the evidence? See, here you have you have existing revaluation reserve. You have revaluation reserve C 800. That means in past there was some upward revaluation. Now, leading to the balance on the revaluation surplus at 1st January X7. Okay, at 1st January X7 the property had a remaining life of 25 years at 1st January X7. Okay, at 31st December X7 the property was valued at 16 million. Now wait, let me highlight. Can you tell me what's the exact date of revaluation? See, I have just 31st December X7 is the date of revaluation. And how did I recognize? They have written at 31st December X7 the property was valued. That means they revalued the property. That means they revalued the property at 31st December X7. Okay. Now what should be the strategy? The strategy should be first depreciate the asset and then revalue. First of all, depreciate the asset and then revalue the asset. First depreciate the asset and then revalue the asset. Okay, go to the trial balance and see what's the existing. See, this is the existing valuation. See, this 18,000 is the existing carrying value. So how we'll depreciate the existing carrying value, divide the remaining life at the beginning of the year, divided by the life, whatever life is given at the beginning of the year. Okay, so 18,000 is the amount. And how much is the life? 25 years. Okay, let's do it in very simple terms. See, it's very easy question. Don't make it difficult. At the beginning of the year, the value of this property was 18,000, but the date of revaluation is year end. So first depreciate it and then revalue it. So 18,000 divided by 25. Wait, 18,000 divided by 72. This is the depreciation. Now let's subtract 72 from 18,000. 18,000 minus 72. It's 720. Sorry, it's 720, not 72. My mistake. So 18,000 minus, now subtract 18,000 less 720. What's the NBV? 17280 is the NBV at the year end. Open your eyes. 17280 is the NBV at the year end. Now, can you tell me what's the valuation? What's the valuation of this property? 16. So that means from 17280 to 16,000, from 17280 to 16,000, the amount, the total decrease is 1280. The total decrease is 1280. This is devalued by, this is devalued by, okay, you can call it impairment as well, you can call it impairment as well. So there is a decrease, there is a decrease in value of 1280. Now use your brain and recall your IS 16 and IS 36. Recall your knowledge of IS 16 and IS 36. Come on, all of you, please participate, please participate, you will learn it. Thing is that whenever the asset values goes down, whenever, listen this summary, whenever you see a downward revaluation or down or impairment, just look at the trial balance. Is there any revaluation reserve? Is there any revaluation reserve related to this asset? The answer is yes. Yes. So first of all, cancel that revaluation reserve. First of all, cancel that revaluation reserve, and then the remaining amount will go in PNL. Then the remaining amount will go in PNL. Okay. So see this. See this. The decrease in value of property is, the decrease in value of property is 1280. Okay. Revaluation surplus or revaluation reserve will be debited by 800, and the remaining difference will go, that is 480 in PNL. Okay. Just this entry, make this entry and everything is done. Make this entry and everything is done. Make this entry and everything is done. Okay. Now the question is, sir, how to post it? How to post this all? First of all, this 480 is an expense. This 480 is an expense of the current year. This will reduce your profit. This 480 is the expense of current year. This will reduce your profit. So it will go in profit reconciliation. This will go in profit reconciliation 480, number one. Number two, this revaluation reserve, I accept, I admit that this is for the year revaluation, so it should go in OCI. It should go in OCI, but in this question there is no SOCI. In this question you don't need to prepare SOCI. In this question you don't need to prepare SOCI. That's why look at here, that's why no need to write in SOCI thing. Directly post in SOCHI. Directly post this thing in SOCHI. Just for this question I'm saying this, just for this question, because in this question there is no SOCI requirement. Okay. Then finally, as you revalued the asset, as you revalued the asset at the year end, as you revalued the asset at the year end, the revaluation means bringing the asset to market value. Revaluation means bringing the asset to market value. So this market value of 16,000 will go in SOFP. This market value of 16,000 will go in SOFP. So just three things, 480. This one more thing I forgot. Yes, this depreciation 720 is also a depreciation expense for the year. This is also expense. This will also go in profit reconciliation. 720 will also go in profit reconciliation. So total four things. 720 expense, depreciation expense will go in profit reconciliation. 480 is another loss, impairment loss, that will also go in profit reconciliation. 800 revaluation reserve in SOCHI, and 16,000 the valuation of asset in SOFP. That's it. That's it. Did you understand? Did you understand? Please reply. Please reply, all of you. One reply, please. Did you understand the points? Did you understand it? Now the easiest part is closing stock. Since years you guys are studying this statement that closing stock has direct relationship with profit. Closing stock has direct relationship with profit. I hope you remember this dialogue. Closing stock has direct relationship with profit. See, it has been discovered that inventory totaling 0.39 million had been omitted from the final inventory count in the above trial balance. That means simple. They have omitted, they forgot to record closing stock by this amount. So the closing stock in the trial balance is already down. So you need to overstate now. You need to overstate. You need to increase the closing stock. You need to increase the closing stock. Okay. And what will be the double entry for this? C. What will be the double entry? C. Simple. Closing stock is your year-end asset. Closing stock is your year-end asset. So when you increase it, you will debit the closing stock. You will debit the closing inventory. 0.39 means 390. 0.39 million means 390. And we all know when closing stock increases, profit also increases. When closing stock increases, profit also increases. So you can write cost of sales. You can write cost of sales, or you can write P&L. You can write here cost of sales or P&L. This is the entry. Or even if you don't like the entry, don't make it. If you have allergy from this entry, leave it. Simply do two things. Go to the balance sheet and increase the closing stock. Go to the SOFP and increase the closing stock. Okay. The second thing, adjust it in income statement. Adjust things in income statement. Okay. Okay. So now all adjustments are done. All adjustments are done. Let's read the requirement first. What is the first requirement? Calculate the adjusted profit of Heford for the year ended 31st December X7. That means they have already given you draft profit. They have already given you draft profit. You need to adjust it. You need, what's the draft profit? The draft profit is 2250. The draft profit is 2250. Okay. Now, the draft profit is 2250. Let's do it. The first thing is, I hope you remember, use your brain, little brain. Convertible loan note, there was a 135. In convertible loan note, there was a 135 interest, and that was your expense. Okay. So we'll reduce. In the second adjustment, you booked an extra contract revenue of 5600, and you booked an extra cost of sales of 3600. You booked an extra revenue of 5600, and you booked an extra cost of 3600. Okay. So I told you at that time as well, you had two options. Number one, to add 5600 less 3600, or you can directly adjust 2000. Both options are equally right. Then there was a depreciation of property of 720. I just told you. Impairment was 480, and the effect of closing inventory was 390. Okay. And the effect of closing inventory of 390, right? Now simply adjust it. Use your calculator. All of you do it using your calculator. All of you do it using your calculator. This will be, please verify it, 3305. This amount will be 3305. This amount will be 3305. This amount will be 3305. Your first 6 marks requirement is done. Don't worry, I'll share the slides with you. I'll share the slides. Don't worry. Now keep the question in front of you so that you can easily make the SOCHI. Keep the question in front of you so that you can easily make the SOCHI. See, now how we make the SOCHI? Write all the share capital and all reserves. See, in the question, ordinary share capital, premium, revaluation surplus or revaluation reserve. The better name is revaluation surplus, convertible option and retained earning. This time I have not made the total column. This time I have not made the total column. It's not required. It's not required. In the last question I made it, but my dear students, it's not required at all. Okay. So the first thing is just copy paste the opening balance. Just copy paste the opening balance of all these things from the trial balance. So the share capital is 20,000, share premium is 3,000, revaluation surplus at opening balance is 800. There is no opening balance of convertible option equity, and retained earning opening is 6270. All these numbers I have just taken from trial balance. Simple copy paste, nothing else. Okay, now let's count it. Let's do counting. The first thing, is there any right issue in this question? Is there any right issue in this question? No, no. Is there any right issue in this question? No. Number two, is there any bonus issue? Yes, yes, yes. Let's post it. From with bonus issue, 4,000 was the increase in share capital. I made the entry for you. 3,000 was the decrease in share premium, and 1,000 from retained earning. Hope you remember 1,000 from retained earning. 1,000 from retained earning. Okay. Then next thing is there any total comprehensive income in this question? As we calculated profit separately and revaluation separately, both things are separate. So let's do the revaluation first. Hope you remember the second last adjustment. Hope you remember the second last adjustment. In that adjustment we decreased the revaluation reserve by 800. Okay. Then what's the profit for the year? It's 3305. The profit is always adjusted. The profit is always added in retained earning. Okay. Then what is the convertible loan note equity option? Convertible loan note equity option was 424. The convertible loan note equity option was 424. You can check it. You can check it in the question. I made entries for you. And finally, one last and ready-made thing, go and pick from the trial balance. Check the question. There are some ordinary dividend paid of 3620. This is a ready-made number from trial balance. Ordinary dividend paid of 3620. See, I have posted all the things. I have posted everything from the question. Now 20 plus 4 is 24, right? This is nil, this is nil, this is 424, and this is going to be 4955. Okay. Your SOCHI is done. If you understand, please write a message. Thank you. Got it? Now the last thing is balance sheet, SOFP. Last thing you need to make is SOFP. And you listen, this is not difficult on Excel as well. These are very simple on Excel. Very, very simple on Excel. You can easily practice. Now the current asset balance sheet. Asset side, hope you remember that you did revaluation on the last day. You did revaluation on the last day and the property came to 16,000. So simply write 16,000. And I think there is no other non-current asset. Go and check the trial balance. There is no other non-current asset. Go and check the trial balance. Okay. Now let's come to inventory. what's the inventory already, in the question? Wait, let me check, what is the inventory already. The existing amount of inventory was 4310. 4310. The existing amount of inventory was 4310 plus, hope you remember adjustment number 5310, 390. 4310 what the was the already existing amount of inventory, plus go and check the adjustment number 5, we increased the inventory by 390. So 4310 plus 390 is 4700. This is 4700. Now, as per my knowledge, there is no adjustment in trade receivable. There is no adjustment for trade receivable. So simply copy and paste from the trial balance. So trade receivable number is 5510. Okay, you can check from the question, you can verify. There was a contract asset. Hope you remember IFRS 15 adjustment number 2. Contract asset of 2500. I calculated for you 2500. Okay. And finally, cash you have to take from the trial balance at this is 10320. So let's tell me the total. Come on, add it up. Come on. Okay, now come to the equities and liability sides. Wait, the first section is equity section. See, now wait. No need to work hard for equity side. Listen, just you need to copy paste. You need to copy paste the closing balance. So 24,000 is the share capital. Okay, convertible option was I think 424. And retained earning was 4955. Okay, so if you add this 29379, this is the total 29379. Okay, right, this is the total equity. Hope you remember the share premium got 0 and revaluation reserve is also 0 now, so no need to write the 0 numbers. Then for convertible loan note, I hope you remember I adjusted something, add or less in the trial balance. We made two entries for convertible loan notes. Okay, so convertible loan note was existing I think 5,000, oh sorry, it was 8,000. 8,000 minus 424 and plus 135, so it makes 7711. You can verify it as well. 8,000 minus 424 plus 135, you can do it. Okay, and for current liabilities, I don't think there was any adjustment for current liabilities, so simply ready-made copy paste from the question. Now let's add it. You will get 39030. 39030. Okay, right, done. I hope you understood the question. If you understood the question, please tell me. Got it? Okay, so now okay, so I'll share these slides with you. Take care. and you have a nice day and you have good papers. Best of luck for your exams. Allah Hafiz.